Thanks so much for tuning into today's Talking Point. I'm your host, Niraj Shah. The case for a chat, the lots is made about FI flows and whether they'll come back, but the DI flows are equally strong and offsetting the kind of outflows that we're seeing. A focus also on key pockets, particularly the ones that our guest might be having in his portfolio in terms of themes at least. And of course, our guest now straddles both the public and the private markets with equal aplomb. Ravi Dharamshi of ValueQuest joins in right now on the show. Ravi, great having you. Thanks for taking the time out.
Morning, Niraj. Thank you for having me.
The pleasure, I must tell you, is entirely ours. Ravi, how do you gauge what risk assets could do post the Fed pivot? Because, or not the pivot really, but the post the Fed commentary. Because until that happened, almost everything that could be stacked up against risk assets looked like, right? I mean, higher rates, higher yields, higher crude prices, geopolitics, refinancing risks, what have you. There is a small change or a big change maybe out there in terms of what the Fed has said and could possibly do. How do you gauge risk assets now?
Niraj, a very loaded question and a very macro question for a stock picker like me to take up front. But I subscribe to what Nilkant says is that, what US has been doing is having a loose fiscal policy and a tight monetary policy. And now the loose fiscal policy there might be a time to tighten that up. But on the other hand, the monetary policy has probably run its course in terms of tightening. So I don't know how long this pause will last. I don't see the rates coming down in a hurry, but they won't go up from here also for sure. See, all these tools in the Fed's kitty have a pretty lagged impact. So the implications of what has happened in the past 12 months are real. We will have some kind of a recession for sure in US. Timing of which and the extent of which I wouldn't want to hazard a guess. So only thing from a Indian equity market fund manager's point of view, what I want to do is avoid having companies in my portfolio that are overly exposed to US markets or domestic market or other developed markets.
Got it. Yeah, actually, we were speaking to JP Morgan's chief emerging market strategist, Pedro Martins, just before we are doing this conversation, and he was saying that their house view is that the US will definitely go the downward growth pathway in 2024 itself. Ravi, you're modest in what you say for somebody who manages such large sums of money. You classify yourself as a stock picker, yes, but I'm sure you look at lots beyond it. I didn't just mean to talk about yields and rates per se, but just the mood around equities to your mind as well. Do you believe that because of all the factors around, tactically, there could be options to buy equities at better valuations over the course of the next 6 months? I didn't mention election nervousness. That might also be there.
I definitely can't rule that out. And also, for once, after a long time, probably bonds look better as an asset class as compared to equities. So one can't deny that the bond yield to earnings yield ratio, especially in the developed markets, is very unfavorable. So money should flow out of equities. For India, however, always provides this contradiction that in a crumbling world, we are actually standing out quite well. Our equity markets are not, as vulnerable. Of course, if there was to be a recession, if there was to be any kind of a crisis that starts in the developed world, it will have its implications on the domestic market as well. But as compared to the past, our markets are far more resilient. The domestic pools of money are far bigger, and they are ready to take advantage of any kind of crisis that unfolds, if it unfolds. So first of all, I have no idea whether the crisis is coming, not coming. It's coming now or whenever. But I know for sure whenever it unfolds, there will be domestic pools of money ready to take advantage of that. So it can get very challenging. I could have known exactly the way the macros are going to pan out and yet missed out on how the markets are going to react to it. It happened in the case of, Russia, Ukraine. It happened in the case of COVID. The first order derivative effects are always, markets are going to go down, which happened in the case of COVID because we had absolutely no idea how the world is going to shape up. And honestly, it turned out to be the biggest greatest entry point in the 10-year time horizon for equity markets. Then Russia-Ukraine war started off, crude spiked up, a lot of things. Energy prices went through the roof. Europe went into recession. The interest rates hike. I mean, you would have, if you had told me that the 10-year-old is going to stay inverted for so long, and US is going to see an interest rate hike to 5%, I would have already sold off my portfolio by now. I should be enjoying holiday somewhere.
And that's a large portfolio.
That is very, that's a very level one thinking. And see, we have other opportunities also opening up all the time. What happens is, in a macro, you tend to take a very market-wide call. And in market-wide call, you tend to miss out on where some pockets of opportunities do exist. So yeah, we have made one big macro call, so to say, where we reduced our exposure to export-oriented sectors and focused more on domestic-oriented sectors. So manufacturing, domestic financials, consumer discretionary, those are the kind of sectors we aligned ourselves with, considering that the things were going to get tough in the global markets, global economy. So, but again, beyond that, I don't think there is much that we can make out of these macro events, unless there is a major, liquidity sucking event, which will have its implication. I mean, we will be collateral damage in that case as well. So again, it's hazardous to take a guess when that starts, if that starts. Right now, I don't see that on the horizon.
So you aligned yourself to domestics now some time ago. Are you continuing with the thought right now?
We are definitely continuing with the thought. I have, in terms of valuations, the room has considerably reduced in these spaces. But there are still pockets left. For example, financials, it's not like financials have been great outperformer. In fact, despite the strong earnings, in fact, there has been some derating in some of the companies. So absolute returns have been made, but it's nothing as compared to the kind of the growth and the cycle revival that we are witnessing. Manufacturing definitely is a theme that has caught fancy. Capital goods, manufacturing, China plus one story, those kind of things have kind of, probably the pendulum has swung really the other way, and we should be a little cautious. We are actually not deploying much incremental capital over here, maybe reducing a little bit of exposure on the margin.
Okay. Ravi, I'll start with the large one first and then move on to the small ones. How does it get difficult or frustrating to see financials, for example, as a pocket, delivering earnings? It's almost a consensus view. I know of no one that I've spoken to on this show who said that they are negative financials, especially banks. Some people at the margin may be mildly less positive on NBFCs, but on banks, not a single person or a single voice of reason is negative. Yet, YTD, the stocks have barely done anything. Does it get frustrating? And what do you tell yourself then in terms of deploying additional capital or keeping this capital?
See, when market agrees with us is not our lookout. We have to look at whether we are wrong in our hypothesis or no. So our hypothesis is plain and simple. The NPA cycle is behind us. The credit growth cycle is ahead of us. There are a little bit of margin issues right now. Growth is picking up, but the growth is still on the retail side, not as much on the corporate side as we would like. And I think the corporate credit growth cycle is still ahead of us. And we can see that on the ground on the manufacturing side. Still probably some more brownfield capex is happening rather than greenfield. And also probably it's not the kind of bank funded capex that is happening yet. So that having said that, I still don't see a reason. Whatever, I disagree with you. There are few people who are naysayers who think that 45% weightage of financials in the index is a very high weightage, and there is only one way for financial sector is to go down. But I am not in that camp at all. I think financials today is a very, very different sector from what used to be 10, 15 years back. Today now we have financials, lending, non-lending. We have exchanges, wealth managers, AMCs, market infra companies, banks, NBFCs. Within NBFCs, we have so many asset financiers, gold financiers. So it's a very, very vast sectors financial, and the drivers of each business are very different. So you're right, there is some amount of margin pressure. That is why there is some negative voices on the NBFC front. But on the bank side, because the cycle has not even begun, is the reason. And the valuations are actually now reaching a point which are at a 5-year kind of a low, if not more than that, for some of the greatest of franchisee. Now, unless we are missing some disruptive force up ahead, and market is sensing that there is a terminal value issue with these companies, I don't see a challenge in these banks.
Thanks. Lovely thought. Thanks for that. But to be honest, Ravi, I mean, yes, you would know a lot more about people who are naysayers. I haven't heard anybody thus far on air coming and telling me that we don't think banks are a good value currently, just banks per se. But the other point that you brought out is the non-lending financials, and there the capital market plays in particular. I mean, they've had a really good run, not asset managers maybe, but the others associated. Do you think it's a pocket that is worth relooking, especially the asset managers, because they kind of haven't really had any growth per se or material stock price performance, despite the fact that the AUMs have only grown?
So AUMs have grown, but the yields have been under pressure. So this is that the competitive pressure has been rising. So that is the reason why they have not done. So markets are always focused on earnings, and earnings have been tepid, to say the least. And also for a 18-24 month period, we had a kind of a lull in the market. There were no IPOs happening. So a lot of these AMCs or capital market plays also have an investment banking piece, or something that is more related to the IPO primary market as well. And that cycle has just about begun in the last 6-9 months. So from a cycle perspective, I believe this is a great time to be buying them. But yeah, the competitive pressure is not yet yielding, and that is leading to the yields remaining under constant pressure. But I think it's now from this point on, it seems like odds are in your favor. If you get the cycle right, I think there is money to be made here.
Got it. We were mapping the returns of, I'm now switching tracks, Ravi. We were mapping the returns of some of the businesses which have actually had a good run or a very good run in the last 6, 9, 12 odd months. One of the pockets out there is this whole EMS space. You've had investments there in the past. I don't know if you still do. My question though is that these stocks are trading at premium valuations largely, but they are talking about some very strong growth for the next 3 years, and then reasonably strong growth in the words of those managements for the decade at large. How do you think about these businesses and these stocks both?
No, thanks, Niraj, for that question. And I think, yeah, it's a constant dilemma that we also face, that we are very bullish from the next 3, 5, 10-year perspective. But from the next 1 year perspective, the valuation seems very, very stretched. So that's a kind of a jugglery that we have to do. Yes, we have trimmed a little bit exposure, but because we believe in the longer term potential and the runway in this, we continue to hold on. It's not a complete exit for us. See, what happens is whenever a new sector comes up and there is a long runway ahead of them, the size and the scale of these companies change dramatically. Right now, these companies are very, very small. So you have to think of it in conjunction with the size of the opportunity. We can actually have some Foxconn and Pegatron being born out of India, Winston and those kind of electronic manufacturing companies, the Taiwanese company. We can have such kind of companies, being built in India over a 10-year horizon. So because of the stretched valuation based on current earnings, you might actually end up making a wrong decision in terms of exiting the space completely. So you stick around, hang around. There will be ups and downs. There will be sometimes challenge in terms of growth, sometimes challenge in terms of margins. But the overall business momentum and the cycle remains so strong that one should, it is far more prudent to stay invested than to take a call and exit. So, the total addressable market, I mean, it's a jargon that I'm using, TAM, keeps expanding for this particular space. Earlier, they were only into, a specific component, or now they are expanding into box build. Eventually, that get into entire OEM and design also. Eventually, there are new spaces also opening up. Like we are trying to get the semiconductor ecosystem to our country, and that can open up an entire new space. So the semiconductor assembly and testing is a completely new space that can change the scale of these companies even bigger from here. So, and government is very clear and persistent in providing incentives and also kind of making sure that the ecosystem shifts over here. So I would say that it's wiser to stay invested despite the stretched valuation. Sure, you can take some money off the table because the valuations are stretched in the short run, but exiting it would not be a wise decision.
Okay, thanks for that answer. I have two more questions, Ravi. The other pocket is defense, and the stocks have done very well. But yesterday I was talking to a relatively small defense company. They did 200 crores in FY23. They have guided to 450 crores FY24, 900 crores FY25, and the management says that they will be doing disservice to themselves if they don't touch a number of 5,000 crores over the next few years. And this is one company, but a lot of other companies are actually citing some very strong growth numbers out there too. Is it a similar story like EMS? The sector may have been there for a while, defense, unlike EMS. But in terms of policy change, it almost seems that there was a rebirth and the sector is only doing well in the last 2-3 years. Is there a long runway there too?
Absolutely. I think the intent of this government has been very clear in terms of reducing imports. India is one of the largest importers of arms and ammunition. So reducing that import is very, very strategic in nature. And there are very few companies that cater to that opportunity. The opportunity size is large. And along with the intent, now there is action on the ground as well. You can see the order book swell up. And you can also see that government has put import ban. Now, import bans are the last resort. But I think what that does is it takes away that pressure on some of the armed forces for procuring local equipment. If you put yourself in the shoes of one of the armed forces procurement manager, and what if you were to buy locally and then something doesn't work, then the entire blame is at your doorstep. So if by government putting in an import ban, what they have done is actually take away that responsibility of that decision making to procure locally. And of course, it's not that the equipment that is made in India is really subpar or something, but it will take a 10-year period before we reach the international new gen technology kind of a thing. But without this kind of protection and without providing this kind of visibility and runway, the local vendor system will never develop. So it is a strategic sector in which we need to develop our own capability. For that, government is doing everything necessary, and that is providing these companies a clear runway and ability to plan for the future. Having said that, yes, these stocks have also run up. They used to quote at 6-8% kind of dividend yield, and now they are quoting at easily at 25-30 multiple. Again, I don't feel this is the end of the defense story. Tactically, a year, 12 months, 18 months, possibly that incrementally the returns from here could be subdued. There might be some shift in the overall nature of the market, but these sectors are nowhere close to being done.
Got it. My final question, Ravi. Out of the blue, you might not have an answer ready for me, but you speak to a lot of managements, you hear a lot, your team hears a lot of con calls, you must be listening to a lot of calls and transcripts too. What has stood out for you in this earnings season on the last, in terms of maybe a comment that a company made, or common themes or common comments that came about a particular theme that made you think, oh wow, I didn't think about this. Maybe growth is faltering here, or maybe growth is going to pick up here, or maybe there is a pivot here. Anything that stood out in this earnings season or the last, or whatever, in the last 3-4 months for a particular sector for you?
No, I think with the kind of exposure we are having, and we keep, actually our thoughts are getting reconfirmed more than anything else, that China Plus One is not a figment of imagination. Whatever is the strategic nature of it is getting converted into boardroom discussion, is getting converted into inquiries, is getting converted into orders. So that is a consistent trend that we have witnessed across many sectors. It's not only limited to one sector. An odd one out is probably chemicals, where there is actually now dumping coming back, Chinese dumping in the Indian market. So I think what people forgot is that, the reason for us getting bullish on chemicals in 2014-15 was that China was shutting down production and India was providing protection. So that led to a runway being available. And then after now 7 years, the protection that India provided was a temporary one and it's gone, while the China was actually shifting production to non-residential area and they are back in the market. So that is kind of leading to dumping now coming back in the Indian market. So you have to, if you have a 20-year runway in terms of, chemicals still being 4% of the world global market and still a large portion rests with China, and we hope that a lot of that production comes to India. In a 20-year story, you can have a 2-3 year pause or a period where the competitive intensity is so high that there is no earnings growth. So you have to be cognizant of that. So I think that has been, again, probably we were slightly ahead of the curve in anticipating that there will be problem in the chemical market. It also stemmed from the fact that valuation had gone berserk. After the 7-year rally, it was almost, the entire sector was a 20-bagger. So there was need to be cautious. New IPOs coming to the market were getting listed at, almost triple-digit PE multiple. So the sector expanded, market cap expanded, and on the horizon, you could see margin issues like freight cost and raw material cost. So that it was time to be cautious. But the way it is panning out, I think the dumping is going to lead to severe downgradation over here in the next couple of 2 to 4 quarters. So that's one more thing that's come out in the earnings. What else? I think, that broadly covers it. Consumer side is coming out to be much weaker than anticipated. I think that is slightly a surprise. We were actually anticipating that, okay, the rural and the bottom of the pyramid in consumer side has not had a bull run like the upper end of the consumer economy has had. So whether it is real estate, cars, everywhere that premiumization trend is there, and the top of the pyramid is actually doing well, the bottom of the pyramid is not doing well. Now, this being an election year, also some MSP increase. Okay, monsoon were not that great, but that is also not an issue. The previous 3 monsoons have been great. So we were anticipating that, okay, these are the times that one should be looking at for the revival of the rural cycle and the bottom of the pyramid. But that is probably delayed by 2 to 3 quarters is what the feeling is right now.
Got it. Lovely insights, Ravi. Thank you so much for these as well and for the conversation today. And to you, your family and team at ValueQuest, from all of us at BQ Prime, a very happy Diwali and a great festive season.
Thank you. Happy Diwali to you and your subscribers and viewers too.
Thank you so much. And viewers, thanks for tuning into this edition of The Talking Point.